Welcome to episode 27 of the SaaS Report. I'm your host, Matt Aird, and today we're going to be looking at Q2 numbers from Okta, CrowdStrike, MongoDB, and Snowflake. And then we're going to review Marc Benioff's recent appearance on the 20VC podcast. He had some interesting things to say about the current state of GenAI, the use cases for Salesforce internally, and how that may be impacting kind of the broader SaaS market. So let's get into it. So we got Q2 numbers from Okta, and their story is very much one of kind of slowing growth, but improving efficiency. ARR growth came in at 13% year over year. So they added 316 million in net new ARR. That was down from 360 million a year ago. And that follows this kind of larger trend of decreasing ARR growth rates over the last couple of years for Okta. But that slowing growth came with better efficiency numbers. So free cash flow margin was up to 22% from 8% a year ago. Operating margin was up to 6% from negative 3% in Q2 last year. They also had much better go-to-market efficiency. So CAC payback came in at 24 months compared to 32 months in Q2 last year. And that comes about due to kind of a lower sales and marketing budget. So they only spent 34% of revenue on sales and marketing this year compared to 37% last year. And then they had a strong kind of net new ARR add for the quarter. So that came in at 152 million in Q2 versus 116 million a year ago. Some other notables from Q2, Rule of 40 came in at 35, which isn't bad. Rule of X in at 47. RPO, that was up 18% year over year to 4.15 billion, so nice and strong. And share price was up about 3% post Q2 earnings. They've got a market cap of 16.23 billion, or about 5.7 times ARR right now. How would you like to add 739 million in net new ARR in the last 12 months? That's the number that CrowdStrike reported in Q2. That represents 20% ARR growth year over year, which is down pretty substantially if we look at the last 12 quarters. Down from a high of 54% in Q2 of 22 to just 20% in Q2 of this year. Now, as we've talked about before, right, this deceleration in growth rates happens to all companies, right? Salesforce is kind of the key example here, right? From high 50% ARR growth rates down to the single digit growth rates that they see today. And the reason for that is it's just really hard to compound growth at high rates when you're working off a high base, right? CrowdStrike now is kind of north of 4 billion in ARR. It just becomes much harder to grow at 40, 50% when you've got that large of an ARR revenue base. But as a shareholder, right, you'd want to see this growth rate stabilize for CrowdStrike somewhere around that 20% mark. So the next few quarters for them are going to be really interesting. From a go-to-market efficiency standpoint, we've also seen some slippage. So CAC payback has increased from 14 months in Q2 of 2022 to 34 months in Q2 this year. Now, again, this is a metric that you would expect to trend in this direction, right? CAC almost always goes up. It just becomes much more difficult for these companies to add net new ARR with the same efficiency as they grow compared to when they were smaller. But again, what we'd be hoping to see here, right, is some stabilization. Can they get that to level off around the 30-month mark and not have it continue to push up into the 40s, 50s, or 60s like we see with some of the other enterprise SaaS companies at the moment? Now, the interesting thing about CrowdStrike is they still trade at a pretty healthy premium. Now, the share price did sell off about 6% post Q2 earnings, so they're sitting at about $105 billion in market cap as I record this. But that puts them at an ARR multiple of about 24 times. Now, to me, with these metrics, right, that's on the high end, to say the least. It's tricky to see how a company that's growing at 20% ARR right now gets a 24 times ARR multiple. If we look at some comparable companies here, right, we've got Confluent, Zscaler, Elastic, and HubSpot. They're all growing around the 20% mark. But they're all getting much lower ARR multiples when we compare them to CrowdStrike. So HubSpot's trading at about 9 times Q2 ARR, Zscaler's at 15 times, Elastic's at 6, Confluent's at 6, and then you've got CrowdStrike as a massive outlier there at 24 times Q2 ARR, right? So I'd say we're gonna wanna see some stabilization in those kind of core metrics if they're gonna maintain the premium that they're currently trading at. Some other headline stats from their Q2 numbers. Operating loss came in at $113 million for the quarter. That's a negative 10% operating margin. Free cash flow came in at 24%. That's pretty typical for CrowdStrike in Q2. ARR per employee at 440,000. Rule of 40 at 44, rule of X at 65. MongoDB shareholders are about $6.4 billion richer after their Q2 earnings announcement. The share price spiked about 35% post-announcement. They saw improvements in almost every kind of key SaaS metric year over year. So if we look at them, ARR growth was up. That came in at 23% year over year versus just 13% in Q2 last year. CAC payback improved, so that came in at 23 months versus 33 months from a year ago. Free cash flow margin was up to 12% from negative 1%. And operating margin improved as well. So that came in at negative 11% in Q2 versus negative 15% a year ago. So really good performance from MongoDB. They added $434 million in net new ARR over the last 12 months. $164 million of that came quarter over quarter. And the improvements in go-to-market efficiency came about due to the strong growth rate, combined with a slight reduction in sales and marketing spend as a percentage of revenue as well. That's down from 46% in Q2 last year to 41% in Q2 this year. They're about 4 quarters into a strategic shift to focus their go-to-market efforts kind of more upmarket, and that seems to be paying off for them. So MongoDB now has 2,564 customers that are paying them more than $100,000 per year. That's up 17% year over year. So really good traction in that go-to-market shift in just a short space of time. So really good quarter from them. They've now got a market cap of about $24 billion, or about 10.5 times Q2 ARR. We got Q2 numbers from Snowflake as well, and they're one of the few SaaS companies at the moment, similar to MongoDB, that are seeing a re-acceleration in ARR growth rates. After 4 straight quarters of declining ARR growth, Snowflake posted a 32% growth rate in Q2 of this year. As we can see on this chart, that's the highest mark for them since Q1 of 2024. They added just over $1 billion in net new ARR year over year. That takes them to about $4.4 billion in ARR. They spent about $1.7 billion on sales and marketing to generate that growth. That gives them CAC payback of 27 months. And again, that's a significant improvement in terms of CAC payback when we compare it to the last 4 quarters. Now, one of the major drivers for Snowflake is their net revenue retention rates. Those have always been strong. They were strong again in Q2 of this year, coming in at 125%. Now, that's down from some of the highs. They were hitting kind of 130, 140% net revenue retention rates a couple of years ago. But in this current operating environment, at the scale they're operating at now, 125% is exceptional. But there's certainly a company that is kind of still chasing growth at all costs, right? No regard shown for kind of operational efficiency. Operating margin was negative 30% for the quarter. So they had an operating loss of $340 million. Free cash flow margin was low as well. That came in at only 5%. Now, Q2 is typically a low free cash flow margin quarter for them. And they are forecasting to hit kind of 25% free cash flow rates, with the majority of that coming in the second half of 2025. Other headline stats, they added 484 customers in Q2. That was up from 334 net new customers in Q2 last year. ARR per employee at an exceptional $522,000. They've got RPO of about $6.9 billion. That was up from $5.2 billion in Q2 last year. A rule of X came in at 68 and rule of 40 came in at 37. So they've got a market cap of $75 billion, or about 17 times Q2 ARR. Marc Benioff was on 20VC this week with Harry Stebbings, Rory O'Driscoll, and Jason Lemkin. And he had 3 really interesting insights into the state of kind of GenAI and the application for this technology inside enterprise software organizations. All right, so insight number 1, he thinks that the potential of the current large language models that we have today is significantly more limited than the proprietors of this technology will want you to believe, right? And the way that he framed this was that, look, these AI models, they're basically, finite algorithms trained on a finite set of data from the internet. And when you interact with them, it feels very impressive, right? It feels like we're on the verge or on the precipice of this kind of intelligence explosion. But based on the way that these things are created, right, we're going to run into basically limitations in the usefulness of the technology pretty quickly. Now, he was quick to point out that that doesn't mean that there aren't interesting applications using the technology today, but what he did point out is that these kind of more far-fetched visions of agents replacing all human labor and this kind of concept of an intelligence explosion are probably overblown. And the limitations exist kind of in the way that these models are created and the limitations that that infrastructure inherently has to it. Now, right, this view flows on pretty nicely from, I guess, a bit of the narrative shift that we've seen over the last few weeks since the launch of GPT-5, right? So prior to the launch of GPT-5, if you'd asked anyone, right, it's like, this AI 2027 plan is probably likely to come true, or if not, there's a decent probability of coming true, right? This concept of this intelligence explosion and the fact that humans are going to be fairly non-competitive in the workforce, right? That was a view that was held pretty strongly by a lot of people prior to the launch of GPT-5, right? Then we get GPT-5 launch and we kind of get this like very incremental improvement in the technology as opposed to this big leap or jump forward that most people were expecting. And I think that what that's done is it's kind of cooled people's expectations around the capability of this technology and how it's going to be applied, how it's going to impact people and their day-to-day lives, right? So Marc is kind of sees his role at the moment in a lot of these conversations with customers is kind of like tempering down expectations and saying, look, the technology is good, it's useful, but it's not quite as capable as maybe some of the promises that you've heard from other sources, right? He sees his role as kind of like being the sober person in the room and going, look, yeah, there's cool stuff we can do with it. The stuff that, most people are talking about is probably not going to be achievable with the technology, right? So that was kind of insight one, right? Is like a bit of sobriety or a bit of rationality to the narrative around GenAI and the usefulness of the technology and potentially some of the limitations that exist with it. The second insight was the fact that, look, whilst the technology is limited, right, and there are limitations, there are real examples of use cases that can be deployed today that can be transformational inside of an organization. And Marc gave us two specific examples from the way that Salesforce was deploying this technology internally. The first was one that's got quite a bit of buzz on LinkedIn this week, and that's around the fact that Salesforce reduced the size of their customer support team from about 9,000 agents down to about 5,000 agents. By agents, I mean humans in this case, right? And the reason that they were able to do that is they've got an AI agent built on Agentforce handling a much larger number of customer queries now than they had before. Now, we've heard this story before, right? Klarna came out publicly a couple of years ago and said, hey, look, we've created this AI agent, creates a bunch of efficiency on a customer support team. It's as good, if not better, than our human agents in terms of resolution time and customer satisfaction. So this isn't a new kind of use case for AI. Interestingly, right, Klarna has actually rolled that back and said, hey, we made a mistake relying so heavily on AI. We're hiring people again. But Salesforce has headed down the same track, right? They see GenAI and the capability of the technology today is pretty good at handling these customer service inquiries, and so they've rolled out an agent to support their customers in doing that, right? But to me, right, as a customer, this use case makes a ton of sense, right? If I am looking for support or help from a business and I just want my problem solved, I don't really care whether an AI agent helps me solve it or a human helps me solve it, right? I just want it solved with as little pain and friction as possible. So if an AI agent is going to be able to do that for me, great, give me the agent, right? Let it help me and I'll be on with my day. The other element to customer support, right, is that the issues that arise are probably pretty well documented within the business, right? Which is like, users experiencing this issue or has this question. The answer to that is likely documented somewhere, and that allows the AI agent to go and fetch the answer to that and then respond to the human in a way that helps them to solve their query. So I think this is an area that we'll continue to see kind of more adoption from large enterprises and smaller organizations as well, is like, how can we turn on a 24/7 chatbot that answers our users' questions so that they can resolve their issues and continue using our service. The other area that he talked about where they're seeing success with AI agents is in the sales development function. So he mentioned this crazy stat that Salesforce has had about 100 million leads come into the business over the 26 years in the company's history that they've just never gotten back to, right? 100 million leads that have come inbound that have just never responded to. And so what they've done is they've created an AI SDR that's going out to these leads now, starting conversations to qualify for fit and see if they can help them, right? So I think what this signals here is that the next kind of wave, so we might see the use cases for GenAI kind of follow this like customer support function first, somewhat predictable, the answers are somewhat documented, and we can resolve user queries quicker, which is all they care about, right? The next wave we might see is around this inbound SDR or BDR, right? These agents that are trained basically to like qualify for fit, answer questions around the product, and point you to a purchase or a demo if you need to kind of register for a demo, right? So you could see that use case again is like, if I'm coming inbound, I just want my questions answered. I'm happy to provide whatever information I need to in order to get those questions answered to see if the product is a fit for me, right? So again, pretty similar to like the support use case there. Now, Marc was clear to point out that the use of these AI agents here in support and in inbound kind of lead qualification and routing isn't going to reduce Salesforce's headcount, right? So he said that basically what they're going to see is a reallocation of headcount from these departments into other departments where they still need humans. And we've seen over the last few quarters that one of those areas that Salesforce is still hiring pretty aggressively is in sales, right? And in account executive positions. So as I kind of record this episode, Salesforce had about 700 open sales positions advertised on the website. There are about 365 open marketing positions, right? So this is still a company that's going to have a lot of employees, right? Salesforce isn't rolling out agents and it's going to allow them to scale back to a kind of a skeleton staff. But those humans, right, that they do employ are going to be deployed in more kind of like value added roles. So think of that as like, account executives and sales engineers as opposed to, customer support agents and, SDRs. Right, the third thing from the interview on 20VC this week was Benioff was extremely bullish on the future of applications and business applications in the enterprise, right? So there's been this take, and I've made this claim as well, that potentially what we see is a paradigm shift in the way that we interact with software, right? So B2B SaaS for a long time has been, basically it's like a set of applications that you log into to, get your work done, right? And you've got like, if we think about kind of the sales front or the business that we run, right? We've got Salesforce and we've got a dialer and we've got LinkedIn, right? And then we've got task management tool, then we've got a reporting tool, right? So we've got all these different SaaS applications that we log into to get our work done. The idea is that potentially due to the rise of AI agents and kind of chat-based workflows, all of those kind of user interfaces may dissolve down to like a chat box, right? Which is like, you could imagine, instead of me going log into Salesforce to see what tasks I need to execute today, I just open up the one window pane view of my business and go, okay, agent, tell me what I need to get done today, right? And it brings back the list of things I need to get done. And then I could then type another request, which would be like, create a campaign report for me for this client, right? And it spits out the report, right? And then it could be, hey, send this email to this person for me. And it goes and sends the email out to the person for me, right? So rather than logging into 3 separate apps to get those jobs done, I simply interact with one UI that's connected to all of the services that I need access to. And so therefore I'm not logging into these different applications, right? So that's the kind of case that people have made, is that basically what you end up with is just a bunch of databases that sit in the background and one user interface or UI that a user interacts with. Now, Benioff, as you might expect, was pretty dismissive of this view of the future. But he didn't, in my view, have a strong point of view on kind of why that's the case. When challenged here around this kind of changing paradigm of how, B2B users will interact with software, his response was, if you think that, you are really wrong and that's crazy talk. And maybe the world changes, but right now in 2025, I need apps and I need agents and I need them to work together, right? So not super compelling, right? Just basically, you're really wrong and that's crazy talk. Not a really strong argument for why the kind of user interface paradigm won't change, but I'm really interested in your perspective here. Do you see a world in which you significantly trim down the number of things that you interact with on a computer or on your phone, and agents are executing a bunch of this work in the background and updating, reading and writing to databases as needed in the background? Or do you align more closely with kind of Marc's view of the world, which is that, look, apps are super important. We need apps today. We're going to continue to need apps over the next 5 to 10 years, right? Let me know what you think. Be interested in your take on it. That's all for this week. Thanks for tuning in. The Q2 State of SaaS report is now underway. I think we're just waiting on 1 or 2 final companies to report, and then I'll be pulling that report together. So if you want to subscribe to the State of SaaS newsletter, do that now, and then as soon as that report's ready, you'll get it in your inbox. Thanks for tuning in today. I'll see you again next week. Until then, goodbye.